So if I were to give you 1 lakh rupees, given the current market conditions, uncertainty or whatever, where are you going to put that 1 lakh? 12 months, let's say.
If I charge you 50%, but I know in my head that if I'm at 2.5% and I can take it to 20, I'm very happy with it. But if I start at 50 and bring it to everybody in the ecosystem is happy.
Do you think there is a crash-like situation or a very deep correction in 2026 or in 2027 in Indian equities?
Yes, I do believe there will be a crash. There should be a crash very soon. It may happen in...
Even if it happens, a global crash which leads to a crash in India by 20-30%, after COVID, this is the best opportunity then to buy.
Right.
Because
this is a unique episode because in this episode, I'm going to present to you 3 market experts who have seen multiple bear and bull cycles. Mr. Gajendra Kothari, MD and co-founder Etika Wealth. Mr. Kirtan Shah, founder and CEO of Triventa Wealth. Mr. Amit Jain, co-founder Ashika Global. In this episode, you are going to hear diverse viewpoints on various assets. For example, Indian stock market, US stock market, gold, silver, and everything in between. A lot of effort goes in planning and executing these episodes. So a humble request that you hit the subscribe button so that me and my team continue to bring quality content to you and we remain motivated. Your subscription is our motivation. Please hit that subscribe button now and enjoy this episode.
Experts, it's going to be an interesting conversation today, right? Especially there is so much going on in the market, right? I don't know, the world order has broken, if I may. So let's start from 2026, okay? So if I were to give you 1 lakh rupees, right? Given the current market conditions, uncertainty or whatever, where are you going to put that 1 lakh? And you have to give me this 1 lakh back after 12 months, let's say. And of course, you can't incur losses. You have to give me with some profits. Okay. So I just want to go to each one of you and ask you, if I give you 1 lakh today for 12 months, short-term duration, right? Where would you put it and why the rationale? So let's start with you, Gajendraji. So 1 lakh for 12 months. Where do you see the opportunity?
Logic says कि आपको debt fund के अलावा कुछ नहीं होना चाहिए because I have to give you back money and it can't be in losses. So I can't take risk. And 12 months is a very short time frame in equities to put in equities or even gold for that matter or any other asset class. Only fixed income is the safe bet wherein I know 6, 7, 8, whatever I can earn and safely back give you more than 1 lakh that you gave me. So that is a logical answer and I would do. But given the nature of investor I am actually, I've been always an equity investor. And even for 1 year, let's say, if I have to take chances, ki kya hai, then I would construct my portfolio in such a way that 80% I'm invested, fully equities, 20% I'm in cash because markets may give me opportunity to invest after 3 months also. Why so hurry, right? We have full year to go. 80% my allocation would be 10% China right now, where we are, 70 India. India mein 70, 40 small cap, 20 large cap, 10 mid cap.
So you're going heavy on small caps?
Yes. Anyway, I'm a very aggressive this thing and small caps at stocks level have corrected quite this thing. So of course, I don't invest my money in stocks, but even at fund level, we are getting very good valuations. So small cap is a good bet from a longer term point of view. Large caps also look decent. That's why 40, 20, this thing. Mid caps continue to look little expensive because it has done very well in the last 5-7 years. So this would be my allocation. 20% cash, maybe for some sector allocation. And of course, I see few sectors which are very cheap. Through my small cap, mid cap, large cap fund managers are any buying. But if sector goes really to deep attractive valuations, I don't mind going directly into that sector and buying that 20%. So that 20% is cash reserve to be deployed. And
what sort of returns could you generate in 12 months with this? Any guesses? Any wild guesses?
It's speculative, of course, but I think we are not at so cheap a level ki if I can do 12 to 15%, I'll be happy with that.
You'll be happy.
I'll be happy.
No gold, silver, Gajendra? Keeping away completely?
Keeping away completely. I'm not comfortable at these valuations.
Right. Okay, no, that's very insightful. Thank you. Kirtan, where would you deploy this 1 lakh?
What if I tell you I don't know what will happen in 2026? Will the audience still consider me an expert?
I think they will. And that's a good starting point.
Because I think, look, whatever is happening today, you don't know Trump is getting off his bed on which side and what mood. Tweets anything. You have any small research company releasing reports and the markets are going turmoil globally. You probably have somebody on the AI side commenting something on a particular sector, and that sector goes for a toss like 15-20% in a day. These are mad markets. I mean, it's only going to be counterproductive for you and I to sit here and guess how 2026 will look like. I mean, definitely I'm no expert to understand where 2026 will look. But if I still have to answer your question, I think I will have 50% India equity and all large caps. I will have 25% debt and 25% gold. That is how I will look at 2026 in whatever little I understand. My logics are very simple to what I'm trying to comment here. I think gold, because I still don't see uncertainties going away in 2026. Till the time Trump is around, and unless he gets preached in the October discussion in the US, that's a separate story. But till Trump is around, I don't see a reason why uncertainties will go away globally and geopolitically by any means. And I think gold is a great hedge. Fixed income, because again, I'm not very confident of how 2026 will be. So at least 7-8% return there will not be bad at all. And India equity only, and not doing global at all, because global's done extremely well lately. I think India's got a great advantage with the time correction over the last 15-18 months where it's not done anything versus global equity. While we are recording this, we already see FIIs coming back. As of yesterday, 16,000 crore of positive inflows in Feb. Whenever FIIs come back and the rupee is stable, typically the first set of stocks they buy are the large caps. While large cap has a large IT component which is moving the Nifty index, but large cap largely, in my opinion, is a great bet to start with if the time horizon is only 2026. So rupee is stable, FIIs are coming back. Great time correction. You look at Q3 earnings, and I'm talking about median and not the average. Q3 median earnings growth was 14% large cap and 18% mid and 18% small. I think at the end of the day, your markets are slaves to earnings, and earnings on Q3 has been really good. So I don't see a reason why, unless something really goes wrong, there is going to be anything hugely bad. But I think higher single digit return and lower to double digit return in 2026 is what I think this portfolio probably can do.
Small caps are down a lot.
Yeah.
Right? From the top. So no allocation to small caps at all. You think there is still a downside?
No. I am very much with him when he says that small cap is a great allocation. But your question was only 2026.
Absolutely.
Right? So I'm being very true to your question.
Okay.
Whether do I
Fair
really
enough.
want to allocate for only 2026 where 10 months are left in small cap? Probably not. And which is why, you give me 3 years, I'll allocate to small cap for sure.
Right. Okay. Understood. Amit, where is your head going? Because for you, 1 lakh, I know is very small amount, but not for me or my audience for that matter.
So honestly, we'll divide into 4 parts.
Okay.
Number 1, we believe that Indian IT sector is giving you a compelling opportunity to buy, and rather I'll say accumulate.
Okay.
So buy is I have to go out today and buy. That's not the way it is going to happen. So you have to start accumulating Indian IT companies till mid-April.
Okay.
That will give you a great kicker if you have a horizon even in 2026 or even beyond. You can hold that because the valuations are compelling. Most of the IT sector companies are trading at an average 10-year PE lesser than 10% of average 10-year PE. So of course, in every business, I think we not only talk about the stock or the businesses, we talk about at what price and what valuation you are getting those businesses. Because you make return by investing on the right price, not only by right company. So price looks perfect to us. So we'll allocate 30% to Indian IT sector.
Okay.
Number 2 sector, I think which will give 30% weightage more is FMCG. We believe that it's a defensive, which is not globally connected, that what Trump tweet tonight
Doesn't matter.
will have least impact on FMCG sector because more a domestic consumption story. And we have seen there are a lot of changes which is done in the tax system. Right? GST has been rationalized. Income tax bracket has been free up to 12 lakh rupees in last budget. So these things are going to give a kicker to FMCG slowly but steadily. And also it is a Trump-proof sector,
Right.
what we can talk about it. So we'll talk about 30% into FMCG. 20% will go with Gajendra ji. That's for debt allocation. In case of any downfall from the global market, we'll keep that debt portion to put into or to average out into fallen down stocks in these two sectors.
Okay.
And rest 20% will keep it into gold.
Gold.
To cushion on anything which Trump tweet and the gold goes up. Something happened overnight from Iran to America or somewhere else in the Gulf and the Western world of it. So gold will give you an hedge. In this strategy, gold and debt mutual funds, they are only proxy for cash.
Right.
So if we get a better opportunity in IT and FMCG because of global market correction, we'll put that money into these two sectors again.
Great. I think I have a follow-up questions on that. So one is, you said IT and FMCG, almost 60% together, right?
Yeah,
30-30.
correct.
Are you looking at large cap, mid cap, small cap in each? Or you going at index level? Or where is the focus for IT and FMCG both?
I'll rather prefer because in a stock, there's a problem. If you take a stock, in IT's example, you take TCS, for example, right? It's fall by 5%. It again fall by 5%. What we have seen in last recent month in February, you will not have guts to average out.
Right.
Because stock can fall up to any limit. There is no limit. But in ITBs or IT ETFs, you'll find a cushion. If something will not do well, some other company will do well. So I'll rather stick to ETF and Bs at this moment of time.
Right. You also none of you actually. So if I look at the allocations you guys have done, you all have avoided silver. So Amit, why avoiding silver?
I think anything which run up too fast, too short, I don't believe in this because that's speculation.
Right.
And we are investors. So I believe that consistency has to be there. And silver, whenever there's too much of narrative, I don't buy narratives.
Right.
So I disassociate myself with complete narratives. As of now, silver has a narrative that everything in the world requires silver. I think when silver touched 4 lakh rupees, the people had that narrative that everything requires silver. And at 250 today, no one talks about that narrative.
Right.
It may go down further, but people will not talk about that narrative again. So I think we generally keep away ourselves from speculations.
Right. No, I think this is a very, very well-rounded opinions I've got here. And it's quite diverse, right? We've gone from very conservative approach that you took, Gajendra ji, to quite bold approach that you've taken, Amit. So that's wonderful. Now, let me ask this question slightly differently. Okay. So if you were to pick only one asset class for 2026, right, which would that be? So let's start from you, Gajendra ji, again.
Broader asset class?
Broader asset class.
Equity.
Equity, Indian equity, US equity. Indian equity.
Indian.
So if you consider gold, NASDAQ, everything, you're saying Indian equities.
Indian equities.
Okay, that's great. What about you?
India large cap.
India large cap. So one asset class, India large cap.
India large cap.
Amit?
If it is only one asset class, I'll go for Indian equities and preferably for large cap only.
Right. It's interesting that nobody is talking about mid cap and small caps at this juncture because maybe the short duration is driving you to think more in terms of
because 1 year is too short a time frame. Given the risk reward profile, large caps are more suitable at this stage from a 1 year perspective. If you flip the question to 3-5 years, of course, it has to be small caps.
Right. In fact, let's actually move to that, right? Let's now forget about short term because I know short term there is a noise and not every investor is looking for doing short term investment. So 10 years, let's go for 10 years, which is quite long term, right? So which asset class, again, let's just break it down to US equities, Indian equities, gold, silver, right? Where would you allocate your funds? So let's start with you, Amit, please.
So for 10 year, I think I'll keep 60 to 70% weight only into Indian equities. India still has a story for 10-15 years. To give you a perspective of this mindset, that Indian equities, if you go with the data, is the best asset class in the world in last 25 years. If you take it from 2001 till today or till last February when we done the research, it's the best asset class in the world in dollar terms, not only in INR appreciation, right? And most of the people have a doubt globally that you have run up so fast, so well. Are you tired? And I always say on the global platform, no, we are not still tired. I think there's a run up in Indian equities for next 10 to 15 years more. And after that, yes, there will be a cyclical downturn, which every economy passed through. For example, from 1930s to 1980s, it was Europe and Japan. Then after 1980s, it was US when they started this fiat currency system and started the petrodollar from 1971. It was a US cycle. And now I think it's the Asian cycle which is coming in after 2000, once China and India got into WTO. Right. So it's a cyclical, right? So we believe that 10, 15 years will at least 60% to 70% to Indian equities and 20% will go into Chinese market. Although we have been investing to Chinese market from 27th March 2024, if I'm not wrong. And from that investment time, within a year, we made 102% return in ETF.
Right.
Which is called Hang Seng Tech ETF, listed on Indian browsers.
Right.
We made that money, right? So I think we'll continue to be bullish on India and China. We'll rather give away the Western world because I think there's too much of hype. And this de-dollarization era will directly or indirectly somehow will impact the US and the Western world big time.
Right. So you are completely bearish on US markets specifically?
Western world.
Okay. Entire Western world. Okay.
Western
fine.
World. And we'll rather focus on East. And because we believe the sun will again rise from the east later or sooner. So 10 years, I think we'll look for only for Asian countries.
Brilliant. Kirtan?
If I have to divide 100 rupees, 20 will go to gold from a 10-year perspective. 80 will stay in equities. Within that 80, 20 will go to US NASDAQ and 60 will go to India, which is going to be spread equally across large, mid and small. So 20 large cap India equity, 20 mid cap India equity, 20 small cap India equity, 20 NASDAQ and 20 gold. That's my allocation if at all we are looking at a 10-year investment time frame. Idea is very simple. I mean, I've not been talking about gold only because gold has gone up. If there are people who've been following me for the last 10 years that I've been talking on the internet, I've been a bull gold for a long, long time. I think what gold solves as a problem in the portfolio is that most of us have seen all cycles, right? I mean, I've seen the 2008 cycle. There's somebody who's old who's seen the 2000 cycle, but I've seen 2008, 2013, 2018, 2020. Aggressive investors are typically always fully invested, right? And if you have a 10 lakh portfolio that falls by, let's say, 40%, it's easy to average it. But if you have a 10 crore portfolio which falls by 40%, how do you average, right? Because if you are an aggressive investor, you are always invested and you know that as a long-term investor, markets are going to go up, but you will never have the monies to invest sizably to be able to average a 10 crore portfolio. I think gold solves that beautifully, right? Because when your market falls 40%, gold probably is the only asset class which will hold steady or go up. And you can actually make money on that 20% of your allocation, remove that and buy equities lower at 40%. And I'm sure I will get that one opportunity in the next 10 years to do that with gold, right? And also gold has not compromised in terms of returns versus equity over longer time frames. Of course, you and I can argue that probably if this is the top, then there have been cycles of 7 years and 9 years in the past where gold took that much time to come back. I mean, that's an argument in the hindsight, probably 10 years later. But I'm sure equity will give us that one opportunity in the next 10 years for me to be able to use my gold and buy equities at the lower level and yet not compromise on returns in any way. That's my gold logic. I've always been a big bull on India and I don't see a reason why, while he quoted about the last 25 years in dollar terms, you look at the last 10 years also, there is only one market in dollar terms which has done better than India, which is the US. You look at China was at 4.4% dollar returns, India was at 8.7% dollar returns. You look at the last 5 years also, there are only 3 markets that have done better. I think if I'm not wrong, it was Taiwan, Korea, and the US, right? It's only the last 1 year or the last 15 months where you saw the South Koreas of the world and the Latin America who's done better, right? So you look at the longer term averages, even not just in rupee, but in dollar terms, India has been brilliantly placed. And I don't see a reason why that narrative changes for India in any sense for 1 decade more or 2 decades more, right? So India is where I want to be outside of the US. US also because I think there are very larger themes that typically evolve globally, which US does a much better job than in India. The argument can be why not China? Because China also does the EV theme really well. It did the solar theme really well. The problem with Chinese economy is the dictatorship and not the democracy, right? You look at the per capita income that China's grown with, right? China's done 3 times more per capita income than India has done, but their markets have not done nothing versus the Indian markets.
Right.
So when you look at the Chinese market, it is the return on the capital employed and not just the per capita or the GDP growth of the economy. So while I'm very bullish on the GDP growth of Chinese economy and their per capita, I don't know if it'll translate down to a market cap advantage as an investor to me, right? And hence, to play themes which are going to evolve in 10 years that I'm currently not aware of, I think US is a better market to play that versus playing the Chinese market. So 60% across large, mid, small in India, 20 in NASDAQ and 20 in gold. That's my allocation.
And INR depreciation, is that the factor also you're considering in that? Because you've got 20% allocation to NASDAQ.
100%. I mean, look, if I have to, what is happening to India, if I may give you a slightly longer answer. On one side, you and I may debate that, exports, the way India has been, are going to now get challenged because you have 200, 300 billions of export that your IT services is doing. Now, hindsight, I'm not sure who's going to be right, whether this will sustain or not sustain. But given the way we currently are, the only way we'll really be able to change or find a replacement to 200, 300 billion of IT services export is IT services itself, or being able to build a secondary manufacturing export.
Right.
I mean, if you look at all the trade deals that India has been signing, and thanks to Trump, I would say so, right? You have EU we've signed with, you have New Zealand that we've signed with, you have Oman, GCC that you've signed with, you are talking to Canada, you're talking to Brazil, your US deal is almost signed. So now what you're doing is, for sectors like the chemicals of the world or the textiles of the world, you're opening up a very large market that didn't exist so far or was always a challenge so far. Now, if we are going to move from IT services to IT services plus a textile or a chemical or XYZ manufacturing led economy, then we will benefit only if the rupee depreciates and we are competitive globally.
Right.
So I don't see a reason why rupee will not continue to depreciate at 3.5%, given the way we currently are poised. And that's an added advantage to have a NASDAQ allocation.
Brilliant. No, that makes a lot of sense. Gajendra ji, where are you looking at from a 10 years perspective?
So I'm assuming that it's a buy and hold portfolio. You can't tinker, right? I mean, you bought today and then you do it for 10 years.
Actually, there might be some minor adjustments along the way, because I think it's very tough to not adjust to the market conditions. It'll be very hard not to do that. So
in that case, then I agree with Kirtan on gold part. Currently, I wouldn't buy gold at this prices.
Right.
I would be all equity rather. But at some point of time when equities have run up and gold didn't do, see, generally these two assets are not supposed to be correlated.
Right.
But 2025 was a year where everything was going up. US, India, China, Korea, everything was going up. All asset classes were behaving except Bitcoin, which, which is nowhere in the picture. See, and this is, I always tell, narratives change, right? October 8, Bitcoin made a high in Indian terms, 1 crore 8 lakh was per. You know what's the price today of Bitcoin? Can anybody guess? See, nobody's talking about, nobody's tracking also.
64,000 USD.
60 lakhs in INR.
60 lakhs.
It's just a 3 months difference or 4 months. 1 crore 8 lakhs has become 60 lakhs, almost 50% correction, and nobody's talking about it, right? Imagine if this case was Indian equities, is bloodbath on the street and so. So it's all narratives. Everything changes. The color changes every year. So generally equity and gold are vice versa, but right now they are behaving very differently. So I don't have the courage to buy gold at these prices. But at some point of time when equities do well, gold doesn't do well, I'll take gold as 20% allocation. Currently, Indian equities, again, US equities has had a dream run for 15 years. See, again, we all forget about history. Look at US returns or developed market returns from 2000 to 2009, zero returns. US economy gave zero while emerging markets did very well. India shining and all, you remember. So these things happen, 15 years dream run, 20% NASDAQ has given CAGR for last 10, 15, 20 years. 1 year, 3 year, 5 year also. Short term, long term. Too good to be true. Right?
But just to play the devil's advocate here.
Correct.
There are reasons for it. And of course, if you look at, at least the story, again, I think I'm going to come back to the point of story. what is driving the US markets? Even if you look at the market cap level, right? It's all the big guys. It's all the technology. It's
Correct.
all the AI.
Correct.
And I think there is a question around how much hyped that is. But there is a reason that US market is going because of the things that they're doing, which other countries are not able to do clearly.
Rahul, the same thing was in 2000 also, na? Nasdaq.com era. Internet was the new AI that time.
Absolutely,
right?
it was. Yeah.
You saw what happened to Cisco, Microsoft. It took 16 years for Microsoft to come to the same prices.
Right.
Didn't Microsoft grow from 2000 to 2016? The answer was yes. But nobody made money as a stockholder.
Right.
Right? So what you buy is important, but what you pay is even more important. Today you are paying, everything is baked into the valuations.
Right. Okay.
Any small error, one Twitter or one release note can actually, take away 13% market cap on one day.
Yeah.
So a small pin can deflate the entire balloon. So I would like to be very cautious. Warren Buffett, the god of investing, $350 billion sitting on cash. He says, I don't understand what to buy. So India looks comparatively much cheaper. And of course, we might have a home bias, but we see things around. India is improving on every parameter. I don't think in the last 25 years, we ever had the best macro case.
Right.
Right? Monetary policy is in great shape. Fiscal is in great order. And that's why small caps particularly tend to do well when macroeconomy is good. India is firing on all cylinders. All those reforms which we have seen in the last 10 years, you'll see it playing out in the next 10 years actually in a major way. Right? So that's all going to help Indian equities more so in the small cap space, the annual spirit. So I'm more bullish from a 10-year perspective on small caps, Indian equity. But given that today it would be like 60-40, 60 small cap, 40 large cap, stay invested, you'll make money.
Okay.
I think I have a point here, if at all that adds meaningfully to the conversation. I think US probably 10 years later is not only going to be a tech story, but a manufacturing story, in my opinion. Because what you look at US doing today is very different from a political standpoint versus what the industry has done. Look, the industry has pushed everybody to talk about AI, but the government is not talking about AI. The government in the US is talking about manufacturing, right? They see geopolitical problems with Taiwan/China. They see oil economy as a problem because of the petrodollar and whatever they are doing. So what they are actually doing is forcing people to come back in the US and start manufacturing. They forced TSMC to move and invest $200 billion in the US and start using the IP that belongs to NVIDIA, right? And manufacture there. They are forcing everybody in the automobile space to come back to the US and start manufacturing in the US. So while they are the largest consumers of sorts in the world, so far what they were doing was they were importing and consuming. Now the pivot that probably the political environment is taking is manufacturing and consuming. And which is why you see the trade deals happening the way it is happening, right? So at least the way I look at it, from a decade from today, you will have to stop looking at US as a tech story, and you will have to start looking at US as a tech, manufacturing and consumption story, which it never was so far.
Right.
Because dollar as a reserve currency compelled them to be able to import and support the world. Given the way Trump is, and I'm not sure how things will look like while he's still there in the power for the next 3 years, but given the way he is, I think it's clear that they are okay with US dollar not being the reserve currency. They are okay with US dollar falling. They are not trying to support the dollar in any sense, right? So,
but doesn't he always talk about it and say that for example, to BRICS, that you guys, if you guys come up with a new currency, I'm going to do this, I'm going to do that. So I think he's concerned about US not being the world's currency.
He's definitely concerned, because if he was not concerned, he would not be attacking Venezuela and all of those guys, 100%. Right? Because ultimately, whatever narrative and story that they peddle out on the internet, the story is petrodollar. Because Venezuela started selling oil to China in yuan, or probably even if you go back to history, because we were talking about history, you go back to Iraq. The reason why Saddam Hussein was attacked was because he was the first one to say that I will start selling oil in some different currency to whoever wants to buy. He is concerned, right? And which is why he doesn't want to break the petrodollar. But look, he's not showing concern that the dollar is falling. The dollar is down 11% over the last 18 months that you and I talk, right? That's not a concern. And that is not a concern because he's moving to a manufacturing-led economy. And if he's moving to a manufacturing-led economy, he cannot have a stronger dollar.
Right.
Because then he'll not be able to compete with the world. So I think he's maintaining a fine balance between allowing the dollar to fall, moving to manufacturing, doing trade deals so that the consumption stays local. And at least that's the way I look at it. And so US is not a tech story. US is tech plus manufacturing plus consumption over the next decade.
I sincerely hope that he knows what he's doing. Because the way you explained makes a lot of sense, but I hope he understands what he's doing, because the way he's coming out with the announcement, on whatever Truth Social, which I'm not on, by the way, is just phenomenal.
But I'll tell you, he's a great negotiator. Look, I don't want the message to go across that I'm a Trump fan, I hate him. But the point is, look at it this way, right? That if I tell Gajendra sir that I'm going to charge you 50%, but I know in my head that if I'm at 2.5% and I can take it to 20, I'm very happy with it. But if I start at 50 and bring it to 20, everybody in the ecosystem is happy.
Right.
He's happy that 50 he came to 20, and I'm happy that from 2.5 I moved to 20. So let's not look at what he's writing. I think he's very smart in that sense, because he's pulled everybody from 0, 2.5, 5 to 18, 19, 20. Which is very good for the US economy in general.
Right. Okay. I think one of the other thing that I've heard on internet a lot is a very famous picture roaming around about the market crash. Okay. Almost, I haven't made any video on it. I'll be very honest with you, because I don't believe in that. Okay. I have my reasons, but I've seen it almost 80-90% creators have taken that picture and scared the hell out of retail investors that market is crashing. I don't know whether it's true or not, but I want to start with you, Amit. Do you think there is a crash-like situation or a very deep correction from where we are now in 2026 or in 2027 in Indian equities?
So for Indian equities, we believe even if there is a crash, it will be because of more global factors, not because of Indian factors. The Indian market at this moment of time, given the growth or PEG ratio of India, I think we are fairly valued. Of course, yes, equities are not FDI. Equities are FIIs who may have a short-term view on the market, right? We may have a crash if there's a global crash. So I'll twist the question a little bit. I'll say if there's a question mark on the global market crash, yes, I do believe there will be a crash. There should be a crash very soon. It may happen in 3 months or 6 months, not beyond it. I think we'll have a crash, mostly into AI-driven stocks and NASDAQ of the world. Because I think they are way beyond what the fair valuation should have been for these companies. But ultimately, as I said, all three of us agreed that for everything you pay a price. Say purely for example, right? Reliance at 1100, great buy. Reliance at 1600, I'll wait and watch. Right. I have a better option, because stock market always work on a theory called relative price attractiveness.
Right.
Today, if something is overvalued, I may find something relatively cheaper where still I see a growth or a better PEG ratio, right? So I'll shift from that stock to another stock which looks undervalued. So given that choice, I think Indian stock market, I'll not be too much concerned. If there's a crash, we might see a V-shaped recovery very soon.
Right.
But for global market, once these valuation crash, will they sustain and will they ever touch these highs? That's a question mark. And when we talk of global market, it's mostly about US, because giving the facts, what we all discussed, go back to 2000. I also read history a lot. So in 1996, go back to 4 years even before 2000 crash, most of the Western world was competing on a business model called manufacturing. Right. So everyone was manufacturing something and exporting to each other. Japan, Europe, and US. India and China was not even there in the picture. How US becomes smarter? They move from an asset-heavy business model to an asset-light business model called technology. Japan, that time, was close to $3 trillion economy. which is now around $5 trillion economy. And US was also $3 trillion economy, which has moved to $36 trillion economy by switching timely. So I think these times come when economies, if don't align with the new mindset, can go for a long-term stagnation of their GDP growth. And I think US is at that juncture that if this crash happen, and also as rightly pointed out by my co-panelist, if there's a fear of losing the dollar as a reserve currency, I think it's very difficult to sustain them. Because what Trump is trying to do, manufacturing, I agree with Kirtan on this line. But the point is, he can bring manufacturing to US. But how will ensure that people there want to work? I spent almost 9 months in Europe and US, last 9 to 12 months in Europe and US, most of the time in Europe. I don't see that these guys want to work.
Right. So labor is going to be
a problem.
Which is very true, actually.
Right. They don't want to work. I was in Davos for World Economic Forum. After 5 o'clock, I don't see anyone on the street.
It's very true.
How you run your economy,
It's
right?
true.
And that's how they have been working for a number of years.
And that is the reason they are in stagflation for a very long period of time.
Right. Absolutely.
In 1995, European stock market was trading 35% premium to US market. So this is Europe. This is Europe. This is US. They were trading 35% premium to US market. Because at that time, US and Europe were comparable, right? Today, European stock market trade 35% discount to US market. That's how the shift has happened in the last 30 years. And I think this cycle will continue even on a worse side because the growth engine of the West is mostly US.
Yeah.
And I think that will slowly shift not to BRICS, even a WIPIC, what we call. So when you talk about, so the Goldman Sachs said BRICS, we say it's a WIPIC because we are investing money in 2025 or 2026. So we have to see which economies are going to do well in next 25 years. So we believe it is going to be a Vietnam, Indonesia, Philippines, India and China.
Right.
So it's a good time when the Western world or Western portfolios should start looking at WIPIC if they want to catch the next growth story of 2 decades.
Right.
That's what it works out to be. So fairly from a stock market crash, yes, there's too much, there are very high possibility. In Indian market, we are not too much of worried. Any downfall will be bought immediately by domestic funds or domestic investors because market is giving us a good growth story at a reasonable valuations.
Right. So you're saying that in case US tech stocks or bubble bursts, there might be a short-term impact on Indian equities as well. But that's not going to sustain because we've got good valuations, we've got good earnings growth coming, macros are good. Therefore, even if it happens, it's not going to be very deeper. And secondly, the recovery should be very quick.
Very quick. It has to be a V-shaped recovery for India.
So we shouldn't really worry too much from that.
Absolutely. If you're in the right sector and right stocks, you should not be worried about it.
Great. Thank you for that, Amit. Kirtan, what do you say about the crash and corrections?
Look, I think there are 3 reasons why probably everybody is talking about a crash. The first reason, and let's try and address each of them. The first reason is probably the Japanese yield curve, right? Yen carry trade was a big discussion from October 24 to March 25 because of which India fell 18-20%, whatever it fell. I think if you look at as of today morning that we are recording, the Japanese yields have moved from 2.35 to 2.1%. So they are no longer going up. They are even going down. And already the Japanese yen carry trade probably has less than 1 trillion available in the market to hurt the market. So I don't think that's a big issue at all. Second issue is the geopolitical issue. I think the world is now shock-proof to geopolitical problems.
सबको आदत पड़ गई अभी.
सबको आदत हो गई अभी. Even when India-Pakistan went to a war, I think our markets fell less than a week. Over the weekend, when the announcement came in, from Monday onwards, the market rebounded and covered all the losses that it made over the last 2-3 days.
I think a lot of people are sitting on the sidelines just to get the fall.
Yeah.
Correct. So geopolitically, I don't really think there is a problem because everybody is expecting worst when Trump is around. So geopolitical situations won't really deter the markets, in my opinion. And the third, of course, like Amit spoke, is the AI bubble in the US. I think AI bubble, at least in my opinion, will continue to be as it is till Trump is in power. I've done a lot of reading around this and to tell you why, look, Trump would really want the stock markets to do well. And if you go back to the first term that Trump was in power, the narrative has always been that. How has a president or a prime minister of a country got to do anything with what Sensex and Dow is doing on a global speech that he is doing? But have you noticed that he comes and talks about how S&P is going to, or Dow is going to hit 100,000 or 1 lakh very soon and all of that? Because for all of his policies and whatever he's trying to do, he wants the capital market to survive. Because if the capital market goes down, most of the things that he's trying to do will not come to light. And which is why one correlation that a lot of people don't generally talk about on the internet is that it's the government capex which is fueling the AI story in the US. It's not actually the private capex. Because private capex is only round tripping of money, right? You have probably an Nvidia buying into OpenAI, right? And then OpenAI uses that same money to buy the GPUs back from Nvidia. So an OpenAI, an Oracle will buy into OpenAI, and OpenAI will buy data center space from Oracle. It's only round tripping of money that's happening in the private capex. It's actually the government capex that is funding whatever is happening. So if for some sorts Trump gets preached in October, or probably something happens before his presidential term has to get over, I think that's a bigger problem to the entire AI story in the US.
Right.
Because look, irrespective of whatever valuations that Nvidia is trading at, and it is out of context for anybody sitting here to put a number whether it is fair and why is it fair. But you still see it doing $1 billion of quarterly earnings, which is unheard of. Right? It's maddening for the kind of monies that they are making. How long will this continue? Nobody knows. But my thesis is that the day probably the government capex stops fueling, I think this story is to be burst. And I would completely agree with him. You go back to history, every time there has been a global reason why India markets have crashed, we've always seen a V-shaped recovery. And also, we've seen a 12, 15, 18 months of time correction. And we've already corrected in that sense, right? So if our markets have to fall, our recovery is going to be much faster. At least that's the way I look at it.
Brilliant. Gajendra ji?
A few things I can see. One is US market, I think it's a huge risk. Particularly, the bubble has to start from there because it's 25% of the global GDP, but 65% of the market cap.
Yeah.
Doesn't go hand in hand, right? Something is amiss here. And it has been playing a very good story for the last 15 years. So the time has come in some sense. Secondly, I always believe risk. Anything, if markets were to crash, it can't be a known risk. Because then it is factored in, right? Stock markets bolte na factored in hai sab. It can't be a known risk. It has to be a very unknown risk, which we are not even talking about today. Something comes and within a week's 10 days, 15 days, market doesn't know what to do and it crashes. So that might happen, which we don't know. Third is, even if crash happens, India will be relatively much insulated because we never participated in the AI story in the first place.
Right.
So जब हम ऊपर गए नहीं तो why we should really go down as much as the other markets have gone up. So Korea went up because Korea was an AI story. China was an AI story. Hang Seng Tech, Amit Jain mentioned last 1 year. So those were AI stories. So Indian. And finally is now Indian ownership of stocks, if you see, it is heavily led by domestic investors also. 20 years, 15 years back, any crash used to happen, it was only foreigners. We used to say foreigners ne becha to sab khatam hai. We never had depth in the market. But today, the SIP book and everything. And a lot of people are sitting on cash. The fund managers are sitting on cash. Investors are sitting on cash. Advisors are sitting on cash. Many layers. So people are waiting to deploy. And last 1.5 years, markets have been slowed anyway. So we have given enough kind of, power now back to the market. So I don't think India will be that much affected. But anything, even if it happens, a global crash, which leads to a crash in India by 20-30%, I think it's after COVID, this is the best opportunity then to buy.
Right.
Because if you are falling for no reason of yours, no fault of yours, and you are strong and steady, your macro is good, your bank balance sheets are great, inflation is great in the country, why you shouldn't load up? It's just narrative is playing somewhere different place, but you can make tons of money out of it.
So adding to his point, I think Gajendraji's point, I think I completely agree. Echo the same view because we have not fallen because of our own fault.
Yeah.
You see, even in IT sector, last quarterly results, there is no impact at all. And still in this month, IT index is down 20%, which is merely a game of narratives.
Right.
Unless we see anything impactful on P&L, which we will see next quarterly result, I think we will not be bearish on IT sector at all. Let the numbers play out. The way the AI narrative is playing out in US, the same way the negative narrative is playing out in Indian IT sector, which we don't believe, because if the best quality about Indians is the adaptions. We adapt very, very fast. And if Indians cannot adapt, I can promise you no one can adapt in the world.
That's a big line, and I totally agree.
It is.
with that.
I agree with you.
हमने बचपन से we have learned to adjust. Right? Even in a traveling to train, there are 3-seater.
Correct.
We get 4 or 5 easily because we like to do that, and we have done that. So on that positive note, I just want to go around one more time and just one last question and quick answer, which is around in 2026. What is that one thing investors should not do, which you are seeing right now in the market, maybe through your social media channels or your interactions with investors? What is that one thing that Indian investors should stop doing in 2026? Gajendra ji.
Cut out the noise, because I think we are becoming experts on everything on daily basis. We're becoming an AI expert, we are becoming a oil expert.
Over analysis.
Zarurat nahi hai. I mean, you don't need to do it.
Right.
When you're buying for 10 years, then why look for every hour or second? I have made money throughout my life by just cutting out the noise. Less actions. The lesser the action in your portfolio, the more money you'll make.
Kirtan.
Stop buying commodities outside of gold.
Okay. So no silver, no copper, no
No
uranium,
silver, no copper,
whatever.
no PGMs, no natural gas, no crude. Who had heard of these things before the
I'm not
market
even
rallied
heard-
over the last 2 years,
Yes.
right? So why now? It's all noise.
Amit.
Don't follow narratives, what any social platform creates. Please follow a logic and make your own opinions.
Brilliant. Gentlemen, thank you so much. I think in the, last 40, 50 minutes, we've gone around the houses and I've got very good, diverse and yet aligned viewpoints on a lot of stories that have been out there. So from the bottom of my heart, thank you so much for your time.
Thank you for having us.
Thank you, Rahul bhai.
Thank you.
If you haven't yet subscribed to our channel, humble request that you hit the subscribe button now, because your subscription is our motivation. My team and me gets really motivated once we see your subscription. So please hit the subscribe button now, and I'm going to see you very soon. Until then, keep rocking.